Every single purchase you make, every job you hold, and every dream you fund rests on an invisible machine. This machine, built on trust and debt, can create vast empires or bring families to their knees. Fast, stylized montage of a skyscraper, a farm field, a credit card swipe, and a person checking a bank balance. We call it money and credit. But what happens when the very foundation of this financial world begins to crack? Context in one breath. This story is about a simple idea that became the single most complex system on Earth: how humans exchange value. Money, which began as mere shell or salt, evolved into digital information, shaping the fate of nations from Washington, D.C. to rural villages in India. It is the story of two inseparable forces, money and credit, and how their delicate balance determines poverty and prosperity, everywhere, for everyone. This story matters now because the rules of this system are changing faster than ever, driven by new technology and staggering global debt, leaving those who don't understand it vulnerable. Timeline of key events. Human commerce began with the barter system, an incredibly slow process that required a difficult double coincidence of wants. You had to want what I had, and I had to want what you had. Animated depiction of an ancient, struggling trade. Around 1200 BCE, simpler and more durable forms of money began to appear in the Mediterranean and East Asia, making trade universally efficient. This new money acted as a medium of exchange, meaning you could sell your goods and use the resulting money to buy anything from anyone else. The shift to metallic coinage around the 7th century BCE in Lydia gave money a standardized and durable value. This innovation allowed wealth to be reliably stored, establishing money's second key function, a store of value. For centuries, the true value of money was tied directly to the gold or silver it contained. The greatest financial revolution came in the 17th century with the creation of the first modern banks and the shift toward paper currency. Banks realized they did not need to keep all the gold in their vaults. They only needed a fraction to cover daily withdrawals. This fractional reserve system allowed banks to begin extending credit, creating money out of debt and funding vast projects like the Industrial Revolution. Engraving of the Bank of England opening. Credit became the powerful engine for economic growth, lending money against a promise of future repayment. In the 20th century, the system changed forever when most major currencies abandoned the gold standard, turning money into fiat currency. Fiat currency, money whose value comes from government trust, not a physical commodity. Now, our money's value is backed solely by government trust and the central bank's promise to control the supply. This final step cemented the central bank's role as the sole manager of a nation's money and credit supply, deciding who gets to borrow and at what cost. Evidence and verification. The core mechanism of modern finance is confirmed by central bank reports globally. Bank deposits are crucial. When you put cash into a bank, the bank uses most of it to issue new loans, only retaining a small portion known as the cash reserve ratio. Federal Reserve Annual Report. This practice is monitored by regulatory bodies to prevent mass panic or runs on banks. The risks inherent in lending are documented through historical credit events. The subprime mortgage crisis, for instance, demonstrated what happens when banks neglect the core terms of credit, specifically collateral and creditworthiness. Document: Lehman Brothers bankruptcy filing, 2008. This collapse showed that when lenders ignore the borrower's ability to repay, the entire system can become toxic. We see a clear global divide in access to fair credit. Research confirms that vulnerable populations lacking traditional collateral are often forced to rely on the informal sector, specifically moneylenders. These informal loans are typically confirmed to carry exponentially higher, sometimes predatory, interest rates compared to regulated banks, as reported by consumer protection agencies worldwide. Conflicting views and gaps. Not everyone agrees on the ethics of the modern credit system. Some economists argue that the ability of banks to create money through lending is fundamentally unstable, claiming it leads to endless cycles of boom and bust. They allege that this system unfairly benefits those who can borrow easily while punishing savers. What we know versus unconfirmed. A major gap in financial data remains the complete lack of transparency in the informal sector. Because these transactions are unregulated and often conducted verbally or with minimal documentation, it is almost impossible for regulators to measure the true extent of debt bondage or the specific scale of predatory lending, leaving millions vulnerable. Alternative solutions are constantly disputed. While institutions like the World Bank champion microfinance and self-help groups as viable poverty solutions, some critics allege these schemes can sometimes add to debt burdens if not managed with strict financial literacy. These varying views highlight that the problem is not merely about money, but about ethical regulation. The direct, everyday impact of the money and credit system is intensely human. For a student in a developing nation, a well-managed education loan or credit can be the only bridge out of generational poverty. It is the respectful, non-partisan difference between having a future and being trapped by your circumstances. Image of a university graduation. Conversely, falling into a debt trap, usually through high-interest informal loans, can be devastating. This is not just a financial issue, it becomes a psychological and social one. Families are forced to make impossible choices, like selling essential assets or pulling children from school, simply to pay the unrelenting interest. The rise of the self-help group offers a compassionate counter-narrative. By pooling small savings, groups of individuals build social capital and a collective guarantee, essentially creating their own internal, formal credit system. This empowers women and local communities to gain autonomy and reject the predatory practices of moneylenders, proving that organized trust can be the most effective form of collateral. Expert lens: why it matters. Think of the economy as a massive, complex machine. Money is the standardized fuel it makes the engine run smoothly. Credit, however, is the accelerator pedal. When the central bank pushes the accelerator, lowering interest rates, the economy speeds up, encouraging borrowing and investment. But push too hard, and the engine overheats with inflation. What would you notice first? This constant balancing act is called monetary policy, and it is the central bank's most vital task. To keep the economy stable, they must manage the interest rate, the price of credit, to control the overall supply of money. If they fail, trust in the currency erodes or the economy stalls. The ethics of credit connect directly to basic human rights. A lack of fair credit access is a barrier to entry into the economic mainstream, effectively cutting off the most vulnerable from opportunities. Understanding these mechanisms, the interest rate, collateral, and formal versus informal sources, is the ultimate lesson in personal sovereignty and economic citizenship. So far, we know that money evolved from bartering to digital fiat and credit. The key to growth is also the source of debt traps. We know that regulated credit is supervised, but unregulated informal lending remains a major opaque problem. The next question is, what real solutions are emerging from this global financial fault line? What's next? The near-term future of money and credit involves three high-confidence scenarios. High confidence. Central banks will launch more central bank digital currencies, CBDCs, to digitize money further and improve transaction speed, but this will raise new privacy concerns. Medium confidence. The gap between formal and informal credit will widen, especially as global interest rates rise, making regulated loans more expensive and pushing more desperate borrowers toward unregulated sources. Low confidence, microfinance and SHG models will see rapid global adoption, successfully challenging the power of moneylenders in all developing economies. The financial machine is always running, and you are either its engineer or its passenger. Understanding money and credit is the best way to secure your financial foundation, no matter where you live. If you want to know more about the actual digital future of money, click here to watch our next documentary. CBDCs, the End of Cash and the Rise of Digital Control. This script is based on confirmed financial history, standard economic principles taught globally, and documented reports from the World Bank, Federal Reserve, and various academic sources on microfinance and debt cycles. All claims regarding informal lending practices are based on established patterns reported by financial watchdog organizations. We strive for neutrality and report facts as confirmed by reliable sources. All visual and information card directions are solely for production guidance. Thanks for watching. Subscribe for more videos.